Hey everyone! Welcome back to the channel. If you've ever wondered how investors, bankers, business owners, and even students understand a company's financial health without reading 100 pages of reports, the secret is something called ratio analysis. Today, we're breaking down the basics in the simplest way possible. No heavy math, no complicated formulas, easy examples. This is part 1 of our ratio analysis series, and by the end of this video, you'll understand what ratios are, why they matter, and the most important types you must know. So let's get started. Section 1. What is ratio analysis? First things first, what exactly is ratio analysis? Think of a financial ratio like a health metric. Just like doctors check blood pressure, heart rate, cholesterol. In finance, we check liquidity, profitability, efficiency, stability, and more. A ratio is simply a comparison between two numbers from financial statements that tells us a story. For example, how well is the company using its money? Can it pay its short-term bills? Is it earning enough profit? Is it taking too much debt? Instead of reading every detail in financial statements, ratios help us zoom in on the most important indicators in just a few seconds. Section 2. Why ratio analysis is important. Now, why do we even bother with ratio analysis? Well, imagine you're planning to invest in a business, or maybe you're running your own startup. Ratios help answer key questions. 1. Are we financially healthy? You can quickly see whether your business is stable or in danger. 2. Are we performing better or worse compared to last year? Ratios let you track progress without reading long reports. 3. How do we compare to competitors? Two companies might look similar, but ratios reveal who's actually doing better. 4. It helps in decision-making. Banks use ratios before giving loans. Investors use them before investing. Managers use them to improve performance. So yes, a ratio analysis is basically the financial world's cheat code to understanding business quickly. Section 3. Types of financial ratios. There are many different financial ratios, but they mostly fall into 5 major categories. In today's video, part 1, we'll cover 2 of the most important ones. 1. Liquidity ratios. 2. Profitability ratios. We'll cover the remaining ones, leverage, efficiency, and market ratios, in part 2. Section 4. Liquidity ratios. Can the company pay its short-term bills? Liquidity ratios tell us if a company has enough cash and short-term assets to cover its short-term debts. In simple words, can we pay our bills next month? Let's look at the 2 most common liquidity ratios. 1. Current ratio. This is the simplest way to check financial safety. Formula: current ratio equals current assets divided by current liabilities. Meaning, more than 1 gives good, less than 1 gives risky. To highlight 5 or 6 gives might mean the company is not using its resources well. Think of it like checking if you have enough money in your bank to pay this month's expenses. That's it. 2. Quick ratio acid test. A stricter liquidity check. The quick ratio is almost the same as the current ratio, but it excludes inventory. Why? Because inventory can take time to sell. Meaning, if the quick ratio is above 1 gives the company is in a strong short-term position. This tells investors, even if nothing sells tomorrow, we can still pay our bills. Section 5. Profitability ratios. Is the company making enough profit? Profitability ratios measure how well a company is turning revenue into profit. It's like checking how much money is left after all expenses. That's what investors care about the most. We'll cover the most important profitability ratios. 1. Gross profit margin. This ratio tells us how much profit the company makes after producing its goods. Meaning, higher equals better. Low margin equals high production cost or high competition. This helps businesses understand whether their pricing or production cost strategy is working. 2. Net profit margin. This one tells us the real story. How much of every dollar earned becomes actual profit. If a company has a 10% net margin, it means from every $100 earned, $10 is real profit. This ratio is super important for investors because it shows long-term sustainability. 3. Return on assets ROA. How efficiently is the company using its assets to earn profit? A company may have a lot of assets, buildings, machines, vehicles, but the real question is it using them efficiently? A higher ROA means the company is making good use of what it owns. Section 6. Limitations of ratio analysis. Short, simple explanation. Before we wrap up part 1, let's quickly talk about limitations. Ratios are useful, but they're not perfect. 1. Ratios are based on past data. They don't predict the future, they just show what already happened. 2. Different companies use different accounting policies, so comparing to companies is sometimes tricky. 3. Ratios don't consider external factors, like economic conditions, competition, or market changes. 4. A single ratio never tells the full story. You always need to look at multiple ratios together. So use ratios as a tool, not the full answer. And that wraps up part 1 of ratio analysis. If you found this helpful, hit the like button, subscribe for more, and don't forget to drop a comment. Ratio analysis, part 2: leverage, efficiency, and market ratios. If you watched part 1 of our ratio analysis series, you already understand the basics, including liquidity and profitability ratios. In part 2, we're going deeper into the ratios that show a company's strength, stability, and long-term potential. Same approach as before. No complicated formulas, no heavy calculations, just simple and clear explanations. Let's begin. Section 1. Leverage ratios. How much debt is the company using? Leverage ratios tell us whether a company relies more on debt or equity to run its business. Using some debt is normal, sometimes even good. But too much debt? That's where danger begins. 1. Debt-to-equity ratio DE. This is one of the most important leverage ratios. It shows how much debt the company has compared to the money invested by shareholders. Meaning, high DD gives company is taking a lot of debt risky. Low DD gives company is more stable, relies less on borrowing. Extremely low DD gives could mean the company is being too safe and not expanding. It's all about balance. 2. Debt ratio. This ratio tells us how much of the company's assets are financed through debt. Think of it as, how much of the company is owned by lenders? Higher ratios mean higher risk. Lower ratios mean more financial safety. 3. Interest coverage ratio. This one answers a simple question: can the company easily pay the interest on its loans? High interest coverage gives safe, stable. Low interest coverage gives company may struggle to pay interest. If someone can barely pay interest on their loans, you know that's a red flag. Same goes for companies. Section 2. Efficiency ratios. How well is the company using its assets? Efficiency ratios show how effectively a company is using what it owns, its assets, inventory, machinery, and more. If profitability shows how much, efficiency shows how well. 1. Inventory turnover ratio. This ratio shows how many times the company sells and replaces its inventory in a year. Meaning, high turnover gives products sell quickly, good sign. Low turnover gives slow sales or overstocking. For example, supermarkets usually have high turnover. Luxury stores usually have low turnover. So it depends on the industry too. 2. Asset turnover ratio. This ratio tells us how efficiently the company uses its assets to generate sales. If a business has a lot of assets but low sales, the asset turnover will be low. That means poor efficiency. Higher turnover equals company is making good use of what it owns. 3. Receivables turnover ratio. This ratio shows how quickly a company collects money from customers. If a company sells on credit and customers take too long to pay back, that's risky. Higher turnover means customers pay faster. Excellent for cash flow. Section 3. Market value ratios. What does the stock market think of the company? These ratios are mostly used by investors and analysts. They help us understand how the market values the company's shares. 1. Earnings per share EPS. EPS shows how much profit the company is making for each share of stock. Higher EPS equals stronger profitability, equals usually better for investors. It's one of the first numbers investors look at. 2. Price to earnings ratio PE. Is the stock overpriced or underpriced? The PE ratio compares the share price to the company's earnings. High PE gives stock may be expensive, but could indicate growth. Low PE gives stock may be undervalued, or the company may not be growing. It's like checking whether you're paying a fair price for the company's performance. 3. Dividend yield. This ratio shows how much return investors get in the form of dividends. Higher dividend yield equals more cash return. Lower dividend yield equals company might be reinvesting profits to grow. Investors who want steady income love high dividend yields. Section 4. How to interpret ratios the smart way. Never rely on one ratio alone. This is where many beginners get confused. Ratios are valuable, but they only tell the truth when you interpret them the right way. Here's how professionals do it. 1. Compare with past years' trend analysis. A company might look good today, but is it getting better or worse? Trends reveal the real story. 2. Compare with competitors' industry comparison. A 10% margin may be great in one industry, but terrible in another. 3. Use multiple ratios, not just one. A company might have good profitability, but terrible liquidity, or great liquidity, but poor efficiency. Every ratio is one piece of a bigger puzzle. 4. Understand the context. Economic conditions, government policies, and global trends affect ratios too. Numbers alone never tell the whole story. And that wraps up part 2 of our ratio analysis series. Now you understand all major financial ratios and how to use them in real life. If you found this series helpful, don't forget to like, share, and subscribe. And if you want me to make scripts for financial statements, cash flow analysis, budgeting, investing, or any business topic, just comment below. Thank you for watching, and I'll see you in the next video.